Hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B. We are in the week 6 of the fall 2021 semester here at UMGC. And today we will be talking about budgeting, capital budgeting, financial budgeting, how to prepare budgets, evaluating the goals, and discussing the differences between centralized and decentralized management with respect to budgeting. Okay, so as we get started, the first thing we're looking at here is the classroom. And I would like to show you exactly what we're looking at for this week. As always, please make sure that you're reading the announcements as you come into the classroom. Last week, you completed your second exam. You completed your week 5 homework assignment, report, and a discussion. This week is a little bit different. You will be providing a copy draft of your 10K project for your peers. You will also be having a discussion. So let's go ahead and take a look. Under content, we're in week 6 now. Can you believe it? There's 3 weeks left. It goes by so fast. Okay, so week 6, you'll have your learning resources here at the top as always. You'll have your homework assignments. We have the peer-reviewed discussion where you'll post a draft version of your PowerPoint presentation for the 10K project. Of course, I will also be providing some feedback for you. You're more than welcome to craft it in the way that you like. My recommendation is to follow the same process you followed for the report. As you recall, over the past few weeks, you have been submitting to me a part of the report each week, and I have been providing you with commentary and feedback. So my recommendation to you is to craft your 10K project presentation the same way the report is written. So following the same direction. You're always more than welcome to reach out to me for any type of questions that you may have as you're drafting the 10K project presentation. My other recommendation I have for that is to post it early, so that way I'll have the opportunity to provide you with direct feedback, and also you'll be able to get feedback from your colleagues in the class. So in addition to your 10K PowerPoint presentation peer review process, you will also have a homework assignment on week 6 as it relates to budgeting, responsibility, and cost. So without further ado, let's go ahead and pop into the presentation and begin the conversation on budgeting. Budgeting is extremely important for both businesses and individuals. Why is a budget important, you might ask? A budget helps to establish guidelines. It helps to establish benchmarking against performance. And it also helps the organization to stay on task as it is trying to accomplish their objectives or their goals. Budgets are very critical for any size organization. It doesn't matter whether it's a for-profit, nonprofit, government agency, any business. Any and all businesses must have a budget, regardless of how small it is or large it is. Extremely important, because this is the only way we can know if the business is on track, and through benchmarking, again, actual performance against the budget. So let's go ahead and talk about the budget from the perspective of a manufacturer. The reason why we talk about budgeting with respect to manufacturing is because it is important for you to understand all of the respective costs that are associated with budgeting. As you may recall from our earlier discussions, I've talked about costs as it relates to manufacturing. For example, direct materials, direct labor, factory overhead. As you recall, direct materials, direct labor, factory overhead equal the total cost of a product. Now, there, of course, a business has other costs, but we look at things like direct materials, direct labor, factory overhead, added together to equal the total cost of a product. We look at the budget with respect to the total cost because we typically formulate a budget starting with a sales budget, and the sales budget is based off of the number of units we expect to sell. And so that's why it's important to understand the total cost of each product that we are attempting to sell. When we look at starting off with budgeting, we look at things like establishing specific goals. What is the budget aim? What is the company's goals? We look at executing plans to achieve those goals. So if we say, oh, our objective is to sell 100,000 units this year, well, how are we going to do that? And of course, the budget will help to guide that, and it'll help to execute that goal. And of course, budgeting, one of the objectives of budgeting is to compare your actual results to your budget, to your goals. Call that benchmarking. Budgeting helps with the managerial functions of planning, directing, and controlling. Planning, directing, and controlling, as you hopefully recall, are functions of management. We plan with respect to budgeting by setting goals to guide decisions. What this does is it motivates employees to meet those goals. The idea of planning for a budget involves multiple stakeholders, management, employees, sometimes external stakeholders. It depends, right? But for the most part, management, employees, the board of directors, they are all in some way, shape, or form involved in planning for the budget. And as we plan for the budget, we're talking about the company's goals and how management can make decisions to motivate employees in order to meet those goals. Earlier, I had said that the first budget that is established is the sales budget. The sales budget is based off of the goals of the business. And the example I had given is 100,000 units we plan to sell next year. That is the goal. How do we meet that goal? We do it through motivating our employees and by having everyone aware through the planning process. Second part, objective of budgeting is directing. Directing it through management function involves decisions and actions to achieve the budgeted goals. We direct, we guide the employees to meet those goals. We guide the company to meet those goals. We guide, we direct through that process. We look at each budgetary unit of the company as a responsibility center. A budgetary unit includes things like, think of like departments. A department is a budgetary unit. The sales department, the marketing department, the manufacturing department. These are all budgetary units. And they're led by managers who have the authority to assist the company in achieving the center's budgetary goals. And the third managerial function is controlling. We control the budget by comparing the actual performance against the budget. How do we control the budget, you might ask? Well, we could make modifications to the budget based off of actual performance throughout the year through a dynamic budgeting process. These comparisons help managers and employees to understand their performance and to make adjustments accordingly. So through the management process of planning, directing, and controlling, it becomes cyclical because the feedback from controlling goes back to planning, back to directing, and then back to controlling. And then the feedback from controlling comes back to planning, directing, controlling. It's cyclical. This cycle repeats itself every single year. It's usually several months before the end of the year. That's when we start to establish budgets. Budgetary period for operating activities includes the fiscal year of the company. As you know, the fiscal year of a company does not always follow the calendar year. A fiscal year is any 12 subsequent months. So, for example, my company, our annual year starts April 1st. April 1st is obviously not following the calendar year. The calendar year is January 1 to December 31. My company's calendar year is April 1 to March 31. It's 12 consecutive months. It is my fiscal year. And if we look at the government, for example, their fiscal year starting in October 1 to September 30, thereabouts, right? Sometimes September 1 to August 31, right? That is the government's fiscal year. So fiscal year doesn't always have to be following the calendar year. It could be starting any month and follows 12 subsequent months. Oftentimes it depends on when the business was incorporated. With respect to budgets, annual budgets are created for the company looking at the 12 months, the fiscal year. And these budgets are typically divided into short time periods like weeks, months, quarters. And the reason why we subdivide the budgets into weeks, months, and quarters is because in business, in most cases, especially when you're selling and manufacturing, no 2 months are the same. No 2 weeks are the same. Heck, even no 2 days are the same. All right. We know that because our sales happen throughout the year. And there's no telling when we sell something. There's no guarantee of a sale, unless you have a contract, of course. But even then, it could be unpredictable. So how do we begin to predict it? We start to budget for it. And we do that by dividing the annual budget into weeks, months, quarters. In a well-organized business that is dynamic, we tend to budget out continuously. Continuous budgeting simply means we are always budgeted out 12 months into the future. We're always budgeted 12 months out. So for example, we are currently in September. I have completed my company's budget all the way through September 2022. Next month is October 1, 2021. Before next month begins, I will have budgeted for October 2022. And then as October is going on, I will be budgeting for November 2022 and then December 2022 as the months progress. We call this continuous budgeting. So therefore, we're continually revising and replacing the data for the month ended with the budgeted data for the same month in the next year. What that means is if I realize that, oh my goodness, my utilities expenses seem to be higher every September than they have been historically, I can then revise my budget for September of the following year. That's what that means. And here's a nice graphic representation of that. So as the year continues, I am continuously budgeting 12 months into the future. And with that budgeted information, I'm taking the current data of the current month and applying that data to the month next year. So I'll take my September 2021 data that I've generated throughout the month and apply that as I'm budgeting for September 2022. It's very important for the business to establish a budgeting system. Oftentimes we develop an annual budget with several months prior to the end of the current year. So for example, I usually start my budget in July in order to be implemented January 1 of the following year. The reason why I start that early, several months in advance, is because many stakeholders are typically involved. For example, when I was a financial controller for Radisson Hotels in New York State, we had many different departments. Those departments had department managers, directors, the general manager. All of these individuals are stakeholders. And these stakeholders are members of the budget committee. The budget committee is steered by myself, the financial controller, or sometimes even the treasurer. And through the process, we sit down with all of our department managers and directors, and they create the budgets for their individual departments. And they submit all of those departments to me in the accounting department, where I then summarize their individual department budgets and create what we call the master budget based off of the individual department budgets. That is why it takes several months to formulate an annual budget. There are a couple of methods when it comes to formulating an annual budget. One of these is called the zero-based budget. With a zero-based budget, it requires managers to estimate their sales, production, and other operating data through operations as if they're being started for the very first time. In other words, I start with zero sales. I start with zero expenses. In my budget, I must estimate my sales. Based off of my sales estimate, I can then estimate the cost of production to produce my inventory for sale. Based off of the sales, I can estimate my direct labor, direct materials, factory overhead for the total number of units I expect to produce and be sold throughout the year. I can also estimate other operating expenses like utilities, rent, marketing, office supplies, you name it, right? There's a whole list of possible expenses. And all of that starts with, of course, sales. The other approach to budgeting, and probably the most commonly used, especially if the business has been operating for some time, is to begin the budgeting process by examining last year's data. We take the actual results from the previous year and apply those results to the next year in order to generate an annual budget based off of actual data. Both of these approaches can be utilized as a static budget or a flexible budget. Now, I will say this. Static budgets are budgets that do not change over time. In other words, once I've set the budget in motion, it cannot be altered later on. This is commonly done with government organizations. Government organizations will develop the fiscal budget for next year, and it is statically based. What that means is they cannot make any alterations throughout the next year, even as transactions occur. Other companies will utilize what we call a flexible or dynamic budget. Dynamic or flexible budgeting means that we can adjust the budget as it's occurring. So static means it stays the same over time, regardless of the level of activity. That's static. Here's an example of a static budget. We have allocated direct labor, electricity, supervisor salaries. In the event that throughout this month or for this year, if my direct labor is higher than the 40,000, I will be over budget. If my electricity is under the 5,000, I will be under budget. If my supervisor salaries are 15,000, I will be at budget, just for example. I had mentioned that flexible or dynamic budgets can be adjusted based off of the level of activity throughout the year. To construct a flexible budget, we follow these three primary steps. First is to identify relevant levels of activity. Levels of activity can be expressed by the number of units expected to be sold and produced, machine hours, direct labor hours, or some other activity base. You may recall this as we talked about activity-based costing in previous weeks. Step two is to identify the fixed and variable cost components as the budget is being constructed. As you know, fixed costs are costs that do not change over time. An example of this would be monthly rent, a mortgage, automobile expense, lease expense, salaries. These are things that do not change over time. Variable costs are costs that change with the level of output. Examples of this would be direct labor, direct materials, factory overhead. These are considered to be variable costs because they will change with the level of production. Other examples of variable costs would include things like electricity, bonuses, sales expenses. All of those are variable costs because they change with the level of output. Step three is to prepare the budget for each activity level by multiplying the variable cost per unit by the activity level and then adding in the monthly fixed cost. So let's take a look at this. Variability is very important when you're budgeting. Think of this as low, medium, high, or low sales, medium sales, high sales, right? The idea here is we are identifying different levels of expected sales, different levels of expected production, low, medium, high. The average, of course, being the level 2, the one in the middle. But the reason why we do this leveling, if you will, with respect to budgeting is because there will be some years where your sales might be lower, or they might be higher, or they might be right in the middle, right? And so the idea behind this is it gives us some variability. So the first step is to identify the number of units of production that are planned for that year from a low, medium, and high level. 8,000 units, 9,000 units, 10,000 units. The next is to discover the variable cost per unit. Variable cost per unit includes direct labor, direct materials, factory overhead, as you know. With respect to the variable costs, we have direct labor, electricity, power, which is a part of factory overhead. And we can figure that out per unit. So looking at level 1, we have a total variable cost of 44,000. How do we get that? 8,000 times $5 per unit of direct labor 8,000 times 50 cents per unit for electricity, getting us a total variable cost of 44,000. Then we have our fixed expenses, electricity, supervisor salaries. Now you see that electricity is in both variable and fixed components. As you may recall, in the previous week, we discussed a thing called conversion costs. Conversion costs can be a part of the manufacturing process and factory overhead. Conversion costs. The other reason why we see variable cost for electricity and for fixed costs is because if you look at your electric bill, you'll notice that there's what we call a base. The base is the minimum, the absolute fixed part. It's the minimum, $50 a month, whatever. And then we add in the variability, the actual electricity used. So think of it as I'm paying $1,000 for the service, and then the $4,000 is coming from the actual usage. It's one way of thinking about it. And another fixed cost is supervisor salaries. And we know that they're fixed because they're the same regardless of the level of output. So to find the total cost for each level, we take our total variable cost plus our total fixed cost. We can see that it's different at each level, as expected, because the total units of production are higher at each level. Flexible budget is ultimately the best because we can make adjustments. We can change it based off of the level of activity. It's much more accurate and more useful than a static budget is. Because remember, a static budget, we cannot change it. A dynamic budget, we can based off of the level of activity. So in comparison to the static to the flexible budget, we can see static budget equals the actual results, and then there's some overage. Well, where did the overage come from? We went over our budget on the static part. Well, that could be somewhat problematic, especially when you're trying to convince your shareholders that you didn't go over budget because of X, Y, and Z, but yeah, you actually did, right? We compare that to the flexible budget. The flexible budget is based off of the level of production. Earlier, we had identified 3 levels of production: low, medium, high. Our actual results came in at 70,800. Well, technically, I'm under budget by $200. How is that? Well, level 3, my total budget was 71,000. So total budget 71,000 minus 70,800 means I'm under budget by 200 using the flexible budget. So as you can see from this example, the flexible budget is much more accurate, and of course will save a lot of headache in the future. So flexible budget is always best when possible. Government organizations, they typically use a static budget, and it's very difficult to change their minds. Earlier, I discussed the concept of a master budget. The master budget is comprised of a bunch of smaller budgets that add up to the master budget. This is departmental based. I'd given the example of when I was working in the hotel business. We had a lot of different departments in the hotel. You got front of house, back of house, including things, departments like housekeeping and engineering. The front of house, including rooms division, which is sales, all of those good things, right? And then back of house also included food and beverage. So there's so many different departments, as you would imagine, within a hotel. And each department has their own manager. Each manager sets their own budget in conjunction with the budget committee. And the accounting office oversees the master budget, which is comprised of all of the individual department budgets. And so that's the complexity of it. And it's prepared on a yearly basis with the budget committee, and it integrates the operating and financial data over time. And yes, it's used to help us to produce a budgeted income statement and balance sheet. So what is a budgeted income statement comprised of? As you know, on the income statement, we have revenue minus cost of goods sold equals gross profit minus your expenses equals net income. That's your income statement, as you recall. So in knowing what's on the income statement, of course, we're going to have quite a bit of budgeted information. We're going to have our sales budget with our cost of goods sold budget that includes the production budget, direct materials purchase budget, direct labor cost budget, factory overhead budget. The reason for all these budgets, individual budgets under cost of goods sold, is, as you recall, these are the expenses that make up a finished good. You have direct materials, direct labor, factory overhead, and other factors of production that equal the total cost of a finished good. So of course, there's going to be a budget for each of those things. And we also have our selling administrative expenses that are correlated with the sales budget. All of these things together equal the budgeted income statement, which derive the budgeted balance sheet. How is that possible, you might ask? Well, direct materials, direct labor, factory overhead. Direct materials, that is the purchase of raw materials. Raw materials is a part of the inventory on the balance sheet. All of those things derive the budgeted balance sheet because, of course, there's also going to be cash involved. So that means that we need to also create a cash budget and a capital expenditures budget. A cash budget is derived from the purchase of direct materials, the budgeting of cash to pay our employees, direct labor, the factory overhead, and expenses. Of course, as you know, all these things are derived by cash. So we budget for cash coming in based off of the sales. We budget for cash going out based off of our expected purchases and expenses. The other type of budget that is derived is called a capital expenditures budget. As you recall, capital expenditures include things like the purchase or sale of property, plant, and equipment. And that could also include things like major repair that would enhance the lifespan of a fixed asset. So this is the flow chart of budgeting. It all starts with the sales budget. The sales budget helps to drive the production budget and, of course, the selling administrative expenses. The production budget drives direct materials, direct labor, factory overhead budgets, which all together drive the cost of goods sold budget. And the cost of goods sold budget, selling administrative expenses budget to drive the total budgeted income statement. So this is just a nice it's a nice flow chart. Sales budget is the beginning of everything, as I had mentioned earlier. It is how we plan for production, advertising, and promotion. It's how we plan for possible price changes, economic conditions, all of these factors that help us to drive the sales budget, help us to really understand our budget for the year for the whole company. So how do we budget for sales? We take our expected sales volume, meaning how many units I expect to sell, times the sales price per unit. Expected sales volume, number of units we expect to sell, times the expected sales price per unit. That gets us to our budgeted revenue, budgeted sales. So let's look at this from an example perspective. Let's say our company sells wallets and handbags. I like wallets and handbags, are nice. Wallets and handbags, we manufacture them and we sell them in two different regions, the East and the West. And you can see based off of the data below, our expected sales volume for the East and for the West, and what our current sales price per unit is. In the East, we have 287,000 wallets, 156,000 handbags. In the West, we have 241,000 wallets, 123,000 handbags. The price, current sales price per wallet is $12. Sales price per handbag is $25. And it's a matter of simply multiplying your expected sales volume times your sales price. And you do that the 4 times, as you can see here. 12 times 287, 12 times 241 for the wallets. Then you would add those amounts together to get your total sales budget for wallets. Then you would take your $25 times 156, and then 25 times 123, you would add those two totals together to get your total sales for handbags. And that's what this looks like here. So you can see that the total wallets expected sales dollars would be $6,336,000. For handbags, we got $7 million. We add up our total wallets, total handbags to get $13,336,000 expected total revenue from sales for the year. That'll be our sales budget. And of course, we can derive the production budget from the sales budget. So $13,336,000 in a budgeted total revenue. We know what our sales prices are. We know what our expected volumes are. So let's take a look at what our production budget is. Now, as you recall, the production budget would include things like direct materials, direct labor, factory overhead. And all of this is derived by the expected number of units we are expecting to sell throughout the year. So going back, I expect to sell 528,000 wallets, 280,000 handbags. So we take our expected units to be sold. We find our desired units in ending inventory, meaning how much do I want to end the year with, minus our estimated units in the beginning inventory will equal our total number of units we expect to produce throughout the year. So let's take a look. We estimate our beginning inventory, wallets 88,000, handbags 48,000. We want to end the year with 80,000 wallets, 60,000 handbags. So looking at our formula, we want to take our ending inventory minus our beginning inventory to equal the number of units we want to or need to produce. For wallets, 80,000 minus 88,000 means I need to produce 8,000 wallets throughout the year. 60,000 minus 48,000. So let's take a look. We expect to sell 528,000 wallets. My desired ending inventory is 80,000. So we take our expected units to be sold plus our desired ending inventory gives us a total units available. Total units available minus the estimated beginning inventory equals the total number of units we expect to produce. So now that we know how many units we expect to produce, we can now develop our direct materials purchase budget. Then we can produce our direct labor budget and then our factory overhead budget. The direct materials purchase budget is how much raw materials we expect we will need to purchase throughout the year in order to produce the number of units. Following a similar process, to formulate the direct materials budget, we follow these 3 steps. First is we find our budgeted materials required for production. In other words, how much raw materials do I need to produce the number of units I expect to sell? Expect to produce. So we take the budgeted production volume times the direct material quantity expected per unit. There's so much raw materials that we need to produce a single unit. The second step is we identify the budgeted materials required for production based on the ending materials inventory to determine the direct materials purchased. In other words, this is how we find out how much materials we need to purchase. So we take our materials required for production from step 1. Then we got our desired ending materials inventory minus the estimated budgeting materials inventory equals our direct materials quantity to be purchased. And this third step is to take the budgeted materials, direct materials to be purchased by taking our direct materials quantity to be purchased from step 2 times the unit purchase price. So let's take a look at our wallets and handbags. Wallets and handbags are made of both leather and lining. To make a single wallet, we require 0.3 square yards of leather and 0.1 square yards of lining. To produce a handbag, we require 1.25 square yards of leather and half a square yard of lining. So, using the information that is given, we can derive the estimated direct materials inventory throughout the process. So let's take a look at the rest of our information. We expect to start the year with 18,000 square yards of leather, 15,000 square yards of lining. For the wallets. For the handbags, we expect to start the year with 20,000 square, for total leather, we expect to start the year 18,000 square yards of leather and end the year 20,000 square yards of leather. We expect to start the year for lining 15,000 square yards and end the year 12,000 square yards. The price per square yard of leather is $4.50, and for lining is $1.20. So step 1, we identify the amount of direct materials for leather and lining for both wallets and handbags. Step 2, we identify the total of square yards available based off of the desired ending inventory plus what we started the year with to get our total square yards available minus our desired ending inventory, minus our estimated beginning inventory equals the total square yards to be purchased. Total square yards to be purchased times the unit purchase price per square yard equals the total direct materials to be purchased That's why sometimes in Excel, it makes life a little bit easier. Sometimes. What about direct labor? Direct labor is a little bit more straightforward because it's labor, right? There's a certain number of hours it takes to produce each product. Handbags, wallets. We would expect handbags probably are going to take a little bit more time than wallets would. We would also expect that there's going to be some variation in labor per hour. So let's take a look at it. There's 2 steps to calculate direct labor. We take the first thing we need to do is budget the number of hours required to produce each unit, or total rather. To do that, we take the budgeted production volume, how many units we expect to produce, times the direct materials quantity per unit. And then the second step is we take the direct labor required for production that we got from step 1 times the hourly rate. So let's take a look. There are 2 departments that manufacture wallets and handbags. We have the cutting department and sewing department. The cutting department takes 1/10 of an hour to produce a single wallet and 1/4 of an hour to produce a single wallet from the sewing department. The cutting department takes 0.15 of an hour to produce a handbag, and the sewing department takes 0.4 hours to produce a handbag. Our cutting department employees earn $12 an hour. Our sewing department employees earn $15. So for the cutting department, we add up the hours required for wallets and handbags. We multiply that by the hourly rate to equal our total direct labor cost per department. And we add up the total direct labor cost per department to get our total labor hour, or I'm sorry, our total direct labor cost. Again, Excel is your friend there. About factory overhead. Factory overhead, as you recall, are the indirect costs that are associated with manufacturing. To estimate factory overhead based off of production, we typically look at things like schedules to separate factory overhead costs into fixed and variable costs. This helps managers to, of course, monitor and evaluate those costs throughout the year. In looking at our factory overhead costs, we have indirect factory wages, supervisor salaries, electricity, depreciation of plant and equipment, indirect materials, maintenance, insurance, property and taxes, so forth and so on. Our total factory overhead costs in this example is $2,089,080. To budget for the cost of goods sold, after we've done our production budget, which included direct materials, direct labor, factory overhead, we budget for our cost of goods sold. Cost of goods sold is budgeted based off of your direct materials, direct labor, factory overhead budgets, plus our conversion costs, work in process, estimated desired of inventories, and our finished goods, which ultimately derive our finished goods, I should say. To budget for cost of goods sold, we take into consideration the direct materials, direct labor, work in process, finished goods. So here's the information that we have. Our direct materials giving us our total direct materials, our work in process amounts, and our finished goods amounts. And as you recall, this information is a part of our balance sheet because it falls under our inventory. So once we've established our, and this is what this is what a cost of goods sold budget looks like. So we have our beginning balances plus our work in process plus our total manufacturing costs that are derived from our direct materials, work in process, finished goods, direct labor, factory overhead. So we have finished goods, work in process, plus total manufacturing costs. So work in process plus total manufacturing costs equals total work in process during the period minus cost of goods manufactured at the end of the year. That's our desired end of year inventory, equals our cost of goods manufactured. Cost of goods manufactured plus our beginning inventory, finished goods, equals our cost of finished goods available for sale. Remember, the term available for sale means it's finished goods, it's ready to go, right? Minus our finished goods inventory desired balance at the end of the year equals our total cost of goods sold. For selling administrative expenses, as you recall, are period costs. Those are associated with these efforts made by the sales department. Include things like sales salaries, advertising expense, travel expense. Administrative expenses will include things like officer salaries, office rent, office supplies expense, miscellaneous administrative expenses. So we take our total selling expenses plus our total administrative expenses to get our total selling and administrative expenses. That was very, very straightforward. And all together now, the budgeted income statement. Budgeted income statement is comprised of the sales budget, cost of goods sold budget, selling administrative expenses budget. And it will also include things like estimates for other income, other expenses, and our estimate for income tax. How do you estimate income tax? Well, of course, it's going to come from your estimated sales. Well, I guess your estimated net income, if you will. Budgets summarized based off of the operating activities of the company. So that's what drives our income statement, as you know, because it's operations. And so this is what the budgeted income statement looks like. Sales budget, cost of goods sold budget, selling administrative expenses budget, right? So what about the balance sheet budget? What about the cash budget? So let's take a look. The cash budget is based off of the estimated cash inflows from sales from our customers and cash outflows, which are cash payments that we make over time for expenses, purchases of materials, etc. The estimated cash receipts based off of what we expect to receive from our customers. You can actually plan this out through a schedule based off of when we expect to receive cash from our accounts receivable and from our walk-in customers. So you can extrapolate the data out from the year based off of each month. So we have expected sales for January, February, March. We have an estimation that we would have some percentage of that in accounts receivable each month. And so based off of what we have in accounts receivable, we have an expectation of a percentage of how much of that accounts receivable we would expect to receive during that month. And that's what this data shows us. And so it's a matter of estimating based off a percentage. So we have estimated sales, we multiply that by a percentage that we expect to have in cash. And then of course, we have a percentage based off of the previous month that we would expect to collect. That's what this shows us. and here's a nice visual representation of that for the following months. Then, of course, we can do the same thing with payments, cash payments being used for various expenses for the purchase of materials over time. And we can extrapolate that outward. So for each month, with the associated sales, with the associated manufacturing costs, we're going to have accounts payable from the purchase of materials, right? And from the wages payable. And so from that perspective, we're able to identify cash payments for this month, the prior month, the current month, and probably the next month. And again, a lot of it is based off of estimates of percentages. It's 25% from the previous month, 75% from the current month. And that's what this is what the schedule looks like for payments for each month. The good news is now, and especially nowadays, a lot of our softwares take care of this stuff for us. It's important to know how to do it, but at the same time, just know that a lot of those type of tasks are now computerized. So the cash flow, as you know, the cash flow statement of cash flows includes your operating activities, investing activities, and financing activities. And of course, we can budget out for each category. And this is what that looks like. We can budget out of that based off of cash coming in from our customers, cash going out for our expenses, and of course, any other types of transactions. So payment of taxes, interest expense, interest revenue, the purchase of new equipment. So operating activities includes your day-to-day operations of the business, cash coming in from customers, cash going out for expenses. In investing activities, we have the purchase or sale of property, plant, and equipment. In this example, sewing equipment will be included there. And then financing activities. Financing activities will include things like dividend payments, issuance of stock, repaying a loan or taking out a loan, things of those nature. And this is an example of what that cash budget would look like on a monthly. So the cash budget in this example, we have the cash coming in from our customers, cash going out for payments. And in this example, the cash coming in, we're looking at the company that expects to have monthly sales will be collected in cash, 40%, and 60% will be collected the following month based off of the accounts receivables. And so that's how we're able to extrapolate this data. So we have January, February, March, our manufacturing costs based off of the levels of production expected for each month, and then our selling administrative expenses planned based off of our expected sales for each month. Capital expenditures, we're just about near the conclusion, but capital expenditures, as I had said earlier on, is the purchase of property, plant, and equipment, the improvement of property, plant, and equipment. Sometimes machines will break down over time, they'll become worn out, they'll become obsolete. So there's a couple of possible actions a business could take in when this happens. We can either replace or repair. That's usually the big decision, right? Replace or repair. I'll give you an example of from my hotel days. We had a chiller on the roof break. A chiller is a very large piece of equipment that cools the building during the summertime. Think of like a massive air conditioner on the roof. And so that broke. And so the chief engineer comes to my office. He goes, "All right, B, well, we need a check for a couple of $1 million." I said, "What's going on?" We don't have that kind of cash just kind of hanging out. So what's going on? And he goes, "Well, the chiller's about to break, or it has broken." And he was like, "Well," I said, "Well, are we going to repair or are we going to replace?" He goes, "Well," I said, "How much each cost?" He goes, "Well, if we repair it, yeah, you're looking at a couple $1 million." I said, "Okay, how much costs to replace it?" "Oh, about 50 million, thereabouts." So, "Oh, okay. Well, we don't have $50 million in our capital expenditure budget, but we have a couple $1 million in the capital expenditure budget to repair it." And then, of course, I asked the question, if we repair it, how much longer will we be able to use the chiller for? Because it's already reached the end of its useful life. He said, "Well, it'll add a couple of years of operation to it." So, okay. So the reason I'm telling you this story is with capital expenditures, the repair or replace decision is based off of the life expectancy of the asset. In order to lengthen the life expectancy of the asset, you can do major overhauls. Like, for example, putting a new engine into a dump truck. That's a major overhaul. That would be a capital expenditure. So that's why it's important for us to establish a capital expenditure budget, because we, over time, will need to repair or replace property, plant, and equipment. So here's an example of that. We have planned for purchases of machinery. We have planned office equipment purchases over time. And as you would expect, the income statement budget and the capital expenditures budget eventually all derive to the balance sheet. And the balance sheet budget is based off of the master budgets, for cash and for capital expenditures and for inventory, all of those things. So that is budgeting. The next part of our discussion today is on centralized and decentralized operations within the company. Centralized operations are where all decisions within the company are made by top management, board of directors, CEO, CFO, the C-suite individuals. All decisions are basically top down. In a decentralized organization, it is the unit level managers, division managers, department managers. They ultimately make the decisions or make recommendations to top management, and top management then delegates the decision making to those division managers, department managers. So it's more central with respect to the actual decision making. The way I like to think about it is centralized decision making comes from top down. Decentralized comes from the middle up. So in other words, top down, they're the furthest away from the customer. They're the furthest away from the product. The division managers in decentralized, they're the closest to the customer. They're the closest to the product. And that's why in most cases, decentralized organization decision-making is more effective, because they better understand the product and their customers. So decentralized, closer to the customer, closer to the product, they're able to make better decisions based off of their needs for their division or their department. And of course, it provides excellent training for managers. It helps managers delegate responsibilities over time. Overall, it's more efficient for customer service related components. Sometimes a negative thing is there could be duplication across divisions within decentralization. In other words, this manager is doing the same thing as the other manager, but they don't know that. And so it's causing duplicated expenses. It's more siloed, if you will. And then one of the other negative things is one manager can make a decision that could have a negative impact on the entire company inadvertently. And here's a nice summary of what we just talked about. Okay, that, my friends, is the conclusion of today's discussion on budgeting and centralized, decentralized operations. As always, if you have any questions, comments, concerns, please feel free to email me, call me, set up office hours with me, whatever it takes. I am here for you 100% of the time. In the meantime, please stay safe, wash your hands, do the right things, and I will see you all again next time. Thank you all so very much for your time today. I appreciate all of you. Have a wonderful day. Thank you so much. Bye-bye.